So to begin with here, over the last 10 years, no surprise, the tech world has been fueled by low interest rates, which has led to cheap, easy to access capital, which has fueled the growth of startups and a lot of risk taking. And as long as this wheel spins positively for long enough, everything is okay. Now, along the way, Silicon Valley Bank, as I said, is central to the tech world, and large venture capital and growth equity firms hold their money at this bank. And then beyond that, invest in startups that also hold their money in this bank, Silicon Valley Bank. And that's led to a rapid growth in deposits at the bank to the tune of tripling deposits up to about $200 billion in just the last few years. Now, with all of that as a backdrop, let's just quickly recap how a bank works. So with banks, depositors put money into the bank, and that deposit is a liability for the bank that they have to repay when the depositors withdraw down the road. Now, with the capital that they've received, the bank then lends the money out or makes investments to ultimately capture what we call a spread, which is essentially the return on the loans and investments over and above the cost of the deposits. And as long as the loans and investments exceed the value of the deposits, you have equity in the bank. And particularly larger banks are required from a regulatory perspective to have a capital cushion so that they don't go under in the way that we just saw Silicon Valley Bank go under. Now, to really understand what happened here, we have to dig into the loans and investment side of the balance sheet. In particular, within that side of the balance sheet, we have really three categories, the first of which is available for sale securities. These are investments that are available for sale. We then have investments that are held to maturity, and then we have loans, and it's really the investments that triggered what we're seeing now with SVB. So the thing to understand about these buckets is that with the available for sale securities, we mark the changes in the value of the underlying securities to market on a regular basis. However, with held to maturity securities, we don't mark them to market unless you sell one of the securities that are held to maturity, in which case you have to mark the entire book to market in the held to maturity portfolio. So in short, banks are incented to move securities to the held to maturity portfolio and to not mark them to market, and then they don't have to recognize losses. Now, the whole problem here arose in the last 6 to 9 months as tech slowed down in the wake of rising interest rates, which caused less risk taking, more shoring up of cash, actually pulling money out of the bank, and really has caused startups to struggle. And that's what we've been seeing in tech again for the last 6 to 9 months. Now, it's worth noting that deposits coming out of a bank aren't always a bad thing. So most banks have FDIC insurance where the deposits are insured up to $250,000 per depositor. However, for any value above that, the deposits are uninsured and you can actually face a loss if the bank goes under. Now, at first blush, Silicon Valley Bank appears to be okay because the vast majority of their accounts are insured accounts where the deposits are fully insured. And in fact, the minority of accounts are uninsured. But the deposit value, the dollars, show a very different picture. So the large chunk of accounts that are insured represent a much smaller amount of the dollar value of the deposits, and the vast majority of deposits for the bank are these uninsured deposits that are essentially the operating cash of a lot of the large tech companies that you know, like Roku, Roblox, Etsy, and so on. And without that operating cash, the businesses will collapse. And so these tech companies have been in this crazy type of dynamic where if they don't pull cash out, then they will suffer because they can't operate their businesses. But if they do take cash out, they could tank the bank, which is what ultimately happened here. And then they're in just as bad of a situation. So all of these tech firms were scrambling to pull money out of the bank as a result of that dynamic. Further exacerbating the situation, tech companies are in very concentrated areas where they all know each other. So we have Silicon Valley on the West Coast, Silicon Alley on the East Coast, and even outside of those two, there's a lot of concentration in these tech hubs around the country, and everyone knows everyone. So they're all talking and they know that the other people in the tech hub are pulling money out. And so it again further exacerbates that situation. And so this very unusual situation might not have even occurred with other banks because you don't typically have large uninsured deposits from tech investors and tech operators that all know each other rapidly trying to pull money out to save their businesses. So to show you how this all played out, again, the tech companies were pulling money out of the bank, and this caused a decline in deposits to $173 billion in deposits by the end of the year, by the end of 2022. And if you aggregated all of the assets that were essentially the collateral offsetting these deposits, it was about $191 billion. And there's a bunch of other little bits and pieces here. I won't get into the weeds of it, but when you look at the balance sheet, essentially there was about $12 billion of net equity. I know the numbers don't perfectly line up here. You can look at the balance sheet on the SEC website and get all the details, but you have to take my word for it. But the catch here, and the big catch, is that in the held to maturity portfolio, there was actually a big unrealized loss. And so essentially the bank was actually insolvent from September of last year, but because they didn't have to recognize the losses, they didn't go under then. And if you were to take the balance sheet as it appears here, there's essentially no equity to begin with. And then as depositors started pulling more cash out in early 2023, 2023, essentially the business's equity was wiped out, and management was trying to offset some of these deposit withdrawals by selling securities. That led to a loss on a sale where they tried to raise capital to offset those losses, and everything started to spin out of control. And once you have the wheel turning where people are nervous about a bank, it causes this negative cycle where everyone pulls money out, which exacerbates the problem, and eventually that ends with what we saw with SVB in the last few days.